Real estate investors have heard a lot about the new 20% pass-through deduction, technically called Section 199 Cap A. But will your rentals qualify? I'm Brandon Hall, CEO of the Real Estate CPA, and today I'm going to give you 4 tips on how your rentals can rise to the level of a Section 162 trader business and qualify for the 20% pass-through deduction. Before we get started, make sure that you subscribe to our YouTube channel. You'll get notified whenever we release new content. And if you like what you hear, please join us on a virtual workshop. You can check it out at www.therealestatecpa.com/virtual-workshop. The first tip is that your rentals must rise to the level of a trader business under Section 162 in order to take a 20% deduction on the rental income. In releasing the final regulations on Section 199 Cap A, the IRS did clarify that your rentals must rise to the level of a trader business under Section 162. The Section 162 standard requires that a business activity be conducted regularly and continuously for the primary purpose of earning a profit. The problem is that historically there's no bright line test for when a rental rises to the level of a Section 162 trader business. But when the IRS released the final regulations in January 2019, they also produced a safe harbor, which leads me to the next tip. Tip number 2, to easily qualify your rentals as a trader business, see if they meet the safe harbor requirements under Revenue Procedure 2019-7. The safe harbor says that a rental activity will rise to the level of a Section 162 trader business if 250 or more hours of rental services are performed in the rental real estate enterprise during the year. And rental services are advertising, negotiating, processing tenant applications, collecting rent, daily operations, management, supervision of contractors and employees. And it's important to note that the hours that your agents, property managers, contractors, employees spend on your rental activities also count towards your 250 hours. The second requirement under the safe harbor is that you maintain separate books and records for each rental real estate enterprise. And the third requirement under the safe harbor, which is not in effect for 2018, but is in effect going forward starting January 1st, 2019, is that you have to maintain a log of your time and hours spent in each rental real estate enterprise, including dates on which the services were performed and who performed the services. If you or your team spend more than 250 hours per year on each one of your rental real estate enterprises, comment below with yes. If not, comment no. This will help me produce better content in the future. All right, the third tip that I have for you today is that you have to be consistent in how you apply your trader business tests. So one of the problems with this 20% deduction is that one rental might be producing net passive income while another rental might be producing net passive losses. Just because one rental is producing net passive losses does not mean that it does not rise to the level of a trader business. So if you apply either the safe harbor or your trader business test to any one rental, you have to apply it across the board to all of your rentals in a consistent manner. So you can't really say that just because a rental produces a passive loss that it doesn't rise to the level of a trader business simply so that you can boost your 20% pass-through deduction. Tip number 4, if your rentals do rise to the level of trader business, you need to issue 1099s at the end of the year. You'll have to issue a 1099 to anybody that you pay in excess of $600 during the year, unless that company is a corporation excluding medical offices and attorneys. Thanks for watching. Make sure that you comment, like, subscribe, share this content with everyone. I really appreciate it.